Based off the previous video, we know that assets equals liabilities plus equity. Let's use an example. So let's say we have assets of $100 million, which is financed through liabilities of $70 million and equity of $30 million. That gives us a total liabilities and equity of $100 million, which is equal to assets and is thus balanced. When looking at the balance sheet, we divide assets into two categories based on maturity. We have short-term assets, which have a maturity of less than a year, as well as long-term assets, which have a maturity of more than a year. Short-term assets are called current assets, whilst long-term assets are called non-current assets. Please note that long-term assets is the American terminology, whilst non-current assets is British terminology. We can also divide liabilities into two categories as well, based on maturity. We have short-term liabilities, which have a maturity of less than a year, as well as long-term liabilities, which have a maturity of more than a year. Short-term liabilities are called current liabilities, and we can call long-term liabilities as non-current liabilities. Please note as well that long-term liabilities is the American terminology, whilst non-current liabilities is the British terminology. When we invest in a company, this is mainly for the long term. Consequently, equity is only long term. Therefore, we do not have short-term equity, so we just use the word equity, which refers to long-term financing only. Following on the previous example, let's say we divide our total assets of $100 million into current assets of $40 million and non-current assets of $60 million. We can then divide total liabilities of $70 million into current liabilities of $15 million and non-current liabilities of $55 million. Finally, equity would be equal to $30 million. In order to check the accuracy of our example, we have total assets of $100 million, which is equal to total liabilities and equity of $100 million. A normal company usually has current assets greater than current liabilities, which means the firm has short-term assets that cover its short-term liabilities. So, the company doesn't have a liquidity problem, which is the firm's ability to pay off its short-term commitments. The relationship between current assets and current liabilities is expressed as net working capital, which is calculated as current assets minus current liabilities. Net working capital is usually positive for a healthy firm, as it signifies that the firm can satisfy their short-term commitments. In real life, net working capital could be negative if a firm cannot satisfy its short-term liabilities on time. To conclude our example, let's calculate net working capital. So, net working capital is equal to $40 million of current assets minus $15 million of current liabilities, which gives us a net working capital of $25 million.